Well, good afternoon, everyone from cold Cleveland, Ohio. It's been a couple months since I've been hosting, so good to see you, fellas.
Good to see you.
Welcome to the April Market Insights. And before we kick it off, let's get the legal and compliance piece out of the way. Perfect. So before we get into, I think there's only one topic really to discuss here in the April session, but let's do a brief recap of what we covered in the March market insights. So whoever wants to take it away.
Yeah, I could start quickly with that one. Really, from the beginning of the year, every month we've been reiterating that there's more uncertainty with everything that's going on, and that increases the potential range of outcomes. And when markets see more outcomes, there's more volatility. And as we've started in April and really at the end of March, we've seen that in full force. And at this point, we have more of a defensive position, which is appropriate for this type of environment. And we don't see that volatility stopping anytime soon. We'll take it one day at a time like we always do, but this is where we are, and we've been, kind of calling that out as the year has progressed.
Yeah, and we've had, quad three on the horizon as you get through the second quarter into the third quarter, and that's even without any tariff impact or disruption. So the setup we had was a risk-off environment anyway. Economic growth slowing, inflation probably has, plateaued, and we see that drifting higher. The fact that it's going to move away from the Fed's mandate is going to constrain them, and likely postpone rate cuts that the market is expecting. And that was a setup that we called out last month, that this is going to transition into a risk-off market. And then when you throw tariffs on top of that, the uncertainty, as Gavin said, widens out a lot. He takes them off the table today and we're up 7%. They could go back on, and that's going to chop around. So imagine being a CEO or a business owner making a long-term decision where you're going to take liquid financial capital and convert it into illiquid physical capital, as businesses do. Who can make decisions in this environment? So we're coming into, the quarterly earnings. How many companies do you think are going to guide analyst estimates higher for the year? Estimates have been coming down, both sales and revenue. We still think they're too high. And I wouldn't be surprised if companies just say, we can't give you guidance on full year earnings because we don't know, what kind of the rules of the game are. So I wouldn't be surprised if volatility stays high all year, and if we're in more of a risk-off market, where managing risk actively, has a year where that really hasn't been needed, say the last couple of years.
Well, that's a good recap and kind of a lead into probably what we want to discuss today. I don't think anyone who's paying attention to markets really has. There's one question on the top of mind, and as you said, we were going over some portfolios this afternoon, and then we were alarmed by this, tariff moratorium, if you will, 90-day, and the market started ripping. So counter to what we were thinking of coming into the day and even through midday. But how does this play out, guys? I mean, no one can predict exactly, what the White House might do, but how do you see this playing out? And you kind of led us into a higher volatility, but where does this all fall, and what's the end game here for the administration and how it's going to impact markets?
I mean, as far as the end game for the administration, they clearly have a vision that doing all this is going to lead more companies, more businesses to invest, inside the U.S. That over this last 30 plus years of, globalization, letting China into World Trade Organization, that it's kind of hollowed out the manufacturing sector, it's hollowed out the middle class, and we were on an unsustainable path. So the way to reverse that, according to the administration, is to play not just hardball, but like brass knuckles hardball, and make it such that the only way around the tariffs would be to build a plant in the U.S., employ, produce, here. And as we've been calling out on previous market insights, it's the sequence that matters as much as the size and the scope. So, with tariffs, the sequence is going to be bad stuff up front on the potential that there's long-term positive. On the spending cuts, it's going to be an increase in unemployment first, a reduction in spending first, on the basis that the people get employed in the private sector, and we lighten the burden on the private sector by reducing government. So the sequence is bad up front, followed by positive. And if you go through each of the policy, realms that are going through change, the sequence is typically bad up front, followed by potential for positive. So there's no way, I don't know anybody that knows, I don't even think the president knows what's going to happen with these tariffs. I think he's going to bring countries to the bargaining table. They're going to work something out. So it's going to be a difficult year from that standpoint. And a VIX of 50, it's not at 50 anymore, but this morning when we got up, it was at 50. That says a typical daily move would be 3%. And when you get swings that big, it's going to chop people up. You're going to see a sharp move higher, and everybody's going to think, okay, this is it. This is the V bottom, and we got to buy this. And then you get 3-4% reversal down, the other way, and people think, oh my God, this is the end. I got to bail. And when volatility is like this and it chops back and forth, sometimes it's better to do less, than do more.
Mm-hmm.
And fortunately, with the strategies we have, where we are managing risk actively, we were taking exposure down in February, and we're at basically minimum levels, beginning of March. Now that doesn't mean that we had any special insight on tariffs, but I'll remind everybody of the old adage about Trump. You don't have to take him literally, but you should take him seriously. And I think he's determined, to apply tariffs. So I think they're going to come back in some form. But again, I go back, even if we didn't have tariffs to deal with, we're still looking at Quad 3, and we're still looking at a treasury that has $11 trillion of treasury securities to push into the market over the next 12 months.
Right.
Who's going to buy that when the Fed isn't buying, foreign central banks aren't buying, commercial banks aren't buying? It's basically the private sector has to take that slack up. That would be enough of a picture to say, I want lower risk, into that environment. Quad 3 with massive treasury issuance on the horizon would be difficult enough to navigate. Now you're putting an accelerant, on top of that, with this policy back and forth on tariffs.
Well, that's good. And that, I think we've always kind of taken the stance as politics is politics. It's hard to manage around politics, so to speak. And, today was a perfect example. And I think what we're saying here today is that, regardless of tariffs or if tariffs were coming, which we knew they probably were, economically things were going to slow regardless of whether tariffs were issued or not at that point.
Yeah, and I think one of the things I like most about our investment process is it's completely apolitical. You know, what any president does, what any Congress does, eventually is going to translate into changes in growth, changes of inflation, and changes in liquidity. So our system is set up to track growth, inflation, liquidity, using various systems, various tools that we have. So it allows us just to focus on the drivers of the market and not get caught up thinking that we have to figure out what the next headline is going to be,
Right.
or get in the kind of the narrative game. It's if it has an impact on growth, inflation, or liquidity, chances are we'll pick up on it. And if it doesn't have an impact on growth, inflation, or liquidity, it's probably not important from an investment standpoint.
Well, that's great. We'll see how things play out. Gavin, do you have anything to add to that? Or
I think that was great. No,
I think
that
Rich
was good.
sums it up really well, especially with his knowledge in the political arena. So I guess
let me just I can't
Sure.
resist a rant here.
Yes.
If you allow me. The tariffs don't even address the right problem. It's our tax code. Stuff gets manufactured here. The burden of our tax code gets embedded in the cost structure. It gets sent overseas, where it now faces two levels of tax: what we embed in the cost structure plus what it bears in the foreign country. So our exports have two levels of tax. They compete against world goods that have one.
Right.
The other side of the trade playing field are imports. Every one of our trading partners has a value-added tax where they make an adjustment at the border to rebate that. So they come in without the burden of the country of origin embedded in the cost structure. So they're tax-free from that standpoint, and they don't pick up the same proportionate tax that domestic products do. So both playing fields are tilted against their own interest. Both are totally self-inflicted. And if we really wanted to address the problem, we would fix the tax code and move the tax base from income to domestic consumption. And by leveling a playing field that's been tilted against us, that would do more to bring a flow of capital to the U.S. than what we're trying to do now with tariffs. So the biggest problem I have is, A, it's a tax, and if you tax something more, you're going to get less of it, period. And B, it doesn't really focus on the right problem in the first place.
Well, maybe in the May market insights, we could address and tear down the tax code and see where that goes.
I would be happy to do that.
I know you would. Well, listen, good session. Lots going on. Volatility, never enjoyable, but it's part of investing. And we look forward to seeing how things turn out for the rest of the month and into the early part of May.
See you soon.
All right. Sounds
Okay.
good, Todd. See you later.
Thanks, guys. Take care.